Great. Hello, everyone, and thank you for joining us at the latest webinar of our How to Enter the European ETF Market series. Some of you may have tuned in before, but for those who haven't, the purpose of these events is to educate listeners on how to enter the European ETF market successfully. To do this, we've invited along members of the ecosystem, which today include a market maker, an exchange, a lawyer, and myself as the white labeler. During the session, we will dive into some questions we are often asked about entering the European ETF market. So by way of introduction, my name is Josh Palmer. I head up business development globally at HANetf. I joined the firm 3 years ago and have a background of 20 years in active management. And maybe starting with Chris, I'll ask my fellow panelists to introduce themselves and give a brief description of their role in the ETF ecosystem.
Thanks, Josh. My name is Chris Bergen. I am a partner in the Asset Management and Investment Funds Group at A&L Goodbody, a leading Irish law firm. In our funds practice, we advise global asset managers on establishing all types of regulated and unregulated investment funds in Ireland, but with a particular focus on ETFs.
Great, thank you. Patel?
Yep. Hi, everyone. My name's Hetal Patel. I am Director for ETF listings at SIBO Europe, which covers our UK and our Amsterdam regulated markets where ETFs can be listed and traded. So primarily working with new and existing issuers to help them launch their products, most of which are UCITS ETFs on our markets, as well as looking after our trading participants. Delighted to be here. Thank you.
And James?
Hi everyone, I'm James Carberry. So I run the ETF pricing desk at Virtue, and I'm representing the market making business here today.
Great, thanks very much, everyone. So now I'll follow with a short introduction to Han, and then we'll go into some questions we're often asked by people talking about entering the European ETF market. So I'll just share my screen. So yeah, just to give you a brief overview of HANetf as a business, the firm started in 2017 and launched its first product in 2018. We've got 8.6 billion in assets across a range of different thematic, active, commodity, and digital assets and crypto ETPs. The firm was started by two successful ETP pioneers, Hector and Nick. That's what Han stands for. And they've successfully launched over a number of businesses, and this is their fourth. So they also launched the firm's ETF Securities, Boost ETP, and Wisdom Tree Europe. So Han provides a full white label ETP solution, including operations, regulatory side, distribution, and marketing. And clients gain access to a senior team with over 350 years of ETF experience. And we also work to lower the barriers to entry for asset managers and other groups wanting to enter the ETP market by reducing costs and increasing the speed to market for those asset managers and others. And a fact that sets HANetf apart from our competitors is that our COO, Manoj, created Europe's first ETF right back at the beginning of the 2000s, and Nick created the world's first gold ETC. So just to go over our current product range. So we've got, as I mentioned, 8.6 billion in assets across 60 ETPs and 60 ETPs, and this includes thematic ETFs, active ETFs, crypto ETPs, commodity ETCs, and then different fixed income options-based and global equity ETPs as well. And here are some of the partners that we work with. So we work with groups like YieldMax, Royal Mint on the gold products, Middlefield, we've just done a conversion of an investment trust for, and various others like Sprott. And recently we've launched Otto BHF's first range of active ETFs on the multi-asset space. So going into why you would choose a white label like HANetf. So what we offer clients is expertise. There's a senior team with a demonstrated history of ETP launches, which is very hard to replicate. We also offer speed to market. So a UCITS ETF approval is about 10 to 12 weeks, and going it alone could take anything from 9 to 24 months, we estimate. And we also give instant access. So you get instant access to a distribution network upon launch that we've built up, including all the APs, market makers, and platforms, etc. We deliver scale. So as part of our platform, we increase the probability of getting onto other investment platforms, of which we're on over 60. And also cost. Going alone is much more expensive, and also the opportunity cost and the time it will take you to launch. So we reckon we probably save you years and millions of dollars by going with a white label solution. And also, as a part of all of this, lowering the barriers to entry to enter the European ETF market for various different entities such as asset managers, family offices, and wealth managers, etc. So just in terms of giving a bit of an overview of the legal entities and the issuing platforms. So HANetf has 2 commingled ICAVs, which we can launch different ETFs on behalf of our clients. We work with JP Morgan and US Bank as custody banks on those ICAVs. And we can launch UCITS ETFs on either an index-based solution or an actively managed strategy across all liquid asset classes, including things like fixed income, equities, options, and commodities. We also have another Irish platform, which is devoted to launching our commodity products. So we can launch ETCs on asset classes which are not eligible for UCITS within this, such as physical commodities like gold, or things like carbon trading products. And then we've also recently launched a 3rd or a 4th platform, which is what we call the multi-asset platform. So this is where we launch the funkier type of products. So things like cryptocurrency or digital assets, short and leverage type products. We can also wrap other ETPs like 40-Ax or 33-Ax, but also derivative-based strategies like single stock covered calls. So if you look at the European ETF market, there's a number of options that are available to people wanting to enter, apart from white labeling. And just to go over these briefly, one option is to buy your way in. So you could buy an existing business. However, based on recent transactions and valuations, this is a very expensive way to go. So other options would include building from scratch. But obviously, this can be complex, expensive, take a long time. You've got to know about all of the regulatory burdens and all of the marketing, capital markets, etc. So we think this is probably 2 to 3 years to set up and 3 to 5 years in terms of the learning curve. You'll find out at the end what you didn't know at the beginning. And then finally, another option is to partner with an existing provider. This is quite a low-cost option and is quite quick. But the issue with this option is there's very limited ownership over what you're building. So all of them obviously have their pros and cons. But if we move on to obviously what we've spoken about at Han, we've spoken about the white labeling option, be it 10 to 12 weeks to launch. We'll do everything for you. There's also another route that we've created, which we call the incubate model, which is effectively where a larger asset manager who wants to enter in more of a bespoke manner could come to us, and effectively we can build a bespoke platform for them, giving them all the benefits of the white label solution. We also this brings flexibility to the client, where they can take over the whole platform in the event that they want to move away from us in the future, with no need for a fund merger. It also has all the benefits of speed to market and reducing the opportunity cost versus building from scratch. And it gives the client the ability to learn alongside ETF during the build process. So clients can effectively slowly build out their capabilities with Han over the 3 to 5 year period of working with us, instead of having to go out and hire staff day one. But there are additional costs to launching a bespoke platform like this. So we only make it available to certain clients looking to build a number of products. But it is worthwhile for clients looking to build multiple products over time, as it gives them the option of taking it in-house at a later date. So in terms of the 2 offerings that HANetf has for different white label clients, we put it into two different groups. One of which is called the core, which is basically anything operational. So this is where, say, a European client has their own capabilities in terms of distribution. We would effectively build the product on their behalf, do all the product design, the regulatory approval, doing the initial listing on a stock exchange, setting them up with all the service providers, etc., through our white label platform, and then also handling all the ongoing capital markets, product management, and operational support, and also all the regulatory oversight. So all the platform governments, dealing with the ManCo. HANetf has the only specialist ETF specialist ManCo in Europe, with a specialist board of directors, and obviously handling all of the regulatory documentation that you need for marketing, such as KIDs, PRIP KIDs, EETs and EMTs, etc. And also connectivity into the established networks that we have of APs, market makers, and a lot of broker and XO platforms across Europe. So we have about 21 APs and 4 or 5 different market makers we work with, and are onboarded at over 60 or 70 investment platforms across Europe. And then the enhanced service is something where a manager can take it right at the beginning if they want to launch with us, or alternatively, they could take it on at a future juncture after the fund is launched. And effectively, this is consultation on product design, including interaction with index providers, but also passporting and listing the new product onto multiple jurisdictions in accordance with the particular regulations of that jurisdiction. But you also gain access to HAN's digital marketing services and our platform distribution services. And also we can look to get additional seed from third parties. So just in terms of giving you an idea of the timeline, I mentioned before that a product or a UCITS ETF into the market would take something like 10 to 12 weeks to approval, and then start the listing. As you can see here, there's various different work streams that we would have when launching a product, including legal, operational, etc. But this just gives you an idea of the launch timeline that you would have if you were to look to launch a UCITS ETF with HAN. The major part of this is obviously the central bank, and Chris will happily talk about that when asking him a few questions later. But that is usually a case of the first round of comments taking 4 weeks, the second round taking 2 weeks, and the third round taking 2 weeks. And also as part of that, we can have side-by-side things like the legal and the operational onboarding with that. But as you can see, that sort of magic line is about the 12-week mark, where we'll look to gain a listing or various listings for the product across Europe. And obviously, Hatal can talk about that later. So just to sort of give you a bit of a key takeaway and overview of HAN, I think it comes down to 4 different things. It's choice, speed, flexibility, and expertise. So in terms of the choice side, basically we can help you choose the right structure for your product, whether it's an ETF, an ETC, or an ETP. We can help you build it, and we've got the all of the different platforms to give you those payout structures. Also, speed. HAN is basically set up to deliver efficient implementation to turn your idea into an investable reality. So as I said, over that sort of 10 to 12 week period is getting a plain vanilla UCITS product out. In terms of flexibility, we can adapt to your requirements. You can either partner with us on the white label or the commingled side. As I said, we've got 2 different platforms we can offer. Or the alternative is we go down more of the incubation route, and you can look to establish your own dedicated ICAV and then use our core enhanced services. And then finally, expertise. So HAN, as I said, has got a senior team with decades of experience, and we're the only multi-platform white label ETP solution provider in Europe with a track record of delivering successful launches for our clients. So maybe starting with Chris. So Chris, active ETFs are a fast-growing segment of the US and now the European ETF market. What are the regulatory considerations for launching an active ETF in Europe, in your view?
Thanks, Josh. I mean, All European ETFs are UCITS fund products, right? And so they're regulated in the same way as a standard UCITS. This means that an Irish ETF is approved by the Central Bank of Ireland. And there's little difference between how a passive or index tracking ETF and an actively managed ETF are regulated or approved by the central bank. For passive, the disclosure and the offering documents will focus on the index construction methodology, and for active, the manager's investment selection strategy. The significant area of focus from a regulatory perspective since the start of the sort of recent rise of active ETFs in Europe has been the fact that all ETFs were required to provide full daily portfolio transparency. And there has been a perception among some fund or some active managers that daily portfolio transparency could give rise to those managers giving away their intellectual property or risk front running of those portfolios. And then, like in that context, it was really pleasing to see that the central bank reviewed its requirements in parallel with what we've seen in other EU jurisdictions, and then update those requirements to facilitate a more flexible model for portfolio disclosure. It took them a while to do that. The central bank had been looking at this and engaging with market participants, going back to feedback they issued on the discussion paper on ETFs way back in 2017. And there's probably an element of the central bank keeping an eye on how semi-transparent products were faring in the US, and perhaps seeing the level of assets that kept flowing to fully transparent active ETFs in the US. But with the increased level of interest in European ETFs from active managers, that gave the industry the incentive that we needed to re-engage with the central bank on the topic. And now you can operate an ETF in Europe, a UCITS ETF, with quarterly portfolio disclosure to be disclosed within 30 days of the quarter end, provided that appropriate information, which does not necessarily mean full portfolio information, provided that that appropriate information is given on a non-discriminatory basis to APs and market makers for the ETF. Now, the flexibility allows managers to decide what level of appropriate information they provide. And there's obviously going to be a level of engagement with the APs and market makers to determine what that is on a product by product basis. But the flexibility is there, and you have the ability to do it weekly, monthly, quarterly, as you deem fit. So, I think it's worth mentioning that that's actually not limited to active funds. You could theoretically do it for passive ETFs too, which is, interesting, but, obviously most relevant to the active market. And also just worth noting, I suppose, that while, we've already been seeing a significant amount of interest in active ETFs and a large number of launches of active ETFs, a lot of that's still been on a fully transparent basis as well. But the flexibility that this gives is definitely going to unlock, more potential for active ETFs for those who may have been holding back and waiting for the flexibility to be introduced. Well, we have it now, and I think there's going to be more to come.
Yeah, so you would probably say that actually this could breed a new sort of uplift in applications.
Yeah, probably more in the concentrated end, those, with the real secret sauce.
I suppose what it gives people is just the optionality and flexibility to be able to enter on their own terms, especially if they're running a particular type of strategy that would, warrant having less transparency.
Yeah, I think so. Agreed.
Yeah.
So, Hetal, have you seen any changes or trends in the type of investors that are using ETFs today?
Yeah, I think first and foremost, to probably say at SIBO, we are, historically, we've been very good at kind of pan-European equities trading and including ETFs. So much so that some people aren't even aware that on a daily basis, on average, SIBO's #1 market share is around 35% on a daily basis of all pan-European equities and ETFs. And so obviously with that, we have access to conversations and information with various banks and brokers, etc., to see what are investors interested in. And that obviously then drives decisions for issuers and managers trying to access new investor segments from some of these existing markets. 2 or 3 things probably we're seeing a lot of is, I know it'll be spoken about probably a fair bit here, is obviously retail or even digital distribution. So we're seeing obviously a lot more increased activity via like robo advisors. Josh, you mentioned, I think Han's got access to quite a number of platforms, retail broker platforms across Europe, app-based investing. So, you know, the Gen Z going on their phone and being able to buy an ETF. We're seeing a lot more of that. Of course, still ETF adoption in Europe and the UK is still far less mature than it is in the US and Canada. But we're seeing significant progress being made. Obviously, Germany is probably the poster child for that, doing really well in Germany, and that's for various reasons, just better accessibility, more education, etc. And that's something we're trying to, from an exchange perspective, where we can play a part, we're trying to do more of. So we've actually, in September, went live with an initiative that has made executing ETFs on Cboe's venues free of charge, and any market data, pricing data relating to those trades free of charge. So whether that's you're a direct broker connected to Cboe or indirectly connecting via one of the big banks, etc. All retail trading on Cboe is now free. So I think that's the first thing, is retail. The second thing is an age-old problem, but we're seeing a slight shift of trading onto exchange versus obviously the traditional kind of RFQ flow. There's been a lot of data, a lot of reports in the last couple of years around RFQ spreads being wider than EBBO spreads on exchange. So I think for us, we're having more and more conversations with some of the banks, the brokers, the buy side, to try and change the narrative that, you know, there's not enough liquidity on exchange, no one's trading on exchange, I can't get the best prices. I think there's a lot out there that proves that on exchange there is real value in it. So we're seeing a lot of some of the big banks developing their own algos, including ETFs in some of their equity algos, and just for us, it's good conversation starters. And then when we speak to issuers, I think we're seeing a match up there, because they're seeing that in terms of the activity that they see in their own products as well. So and then the last one is probably, we've touched on this before, expansion into like new regions. So which regionally, where is the demand coming from? And I think Chris touched on it, obviously UCITS, but I think for us, we're seeing a lot more demand from kind of Latin American, Middle East banks, brokers, who want to, you know, tap into the UCITS ETF market for various reasons. But I think for us, we're seeing through conversations with issuers as well, a lot of growth there. And also from US asset managers who are obviously looking, and very relevant for this conversation, US asset managers are also looking to come into Europe. The successful mutual fund US shop, who's just kind of either looking to do an ETF share class or convert some of their successful US products into a UCITS ETF. So they're probably the 3 or 4 key areas and things that we're seeing in terms of trends at the moment.
Yeah, that's great. That's really useful. And I think you've sort of touched on something which is quite important, which is UCITS is global. You know, it's not something just for Europe, but obviously you've got the benefit of the fact that it is a very well recognized structure within or set of rules within Europe, but also works in LATAM very well, and other parts of the world like Asia. I mean, we had a recent trip to the US where certainly a couple of the conversations were not necessarily focused on European distribution, but that was an additional benefit that it will bring. And obviously, you know, another important touch point is the rise of retail. You know, things that certainly managers are finding of interest within Europe. You know, the total market now is about 3.2 trillion, I believe. The active market is around the 100 billion mark or slightly less, but it's about 15 to 20% retail penetration within that, depending on obviously the strategy, but that's as a whole. And obviously what we're seeing now is that starting to rise. We talk a lot about savings plans, as you say, sort of Germany is a bit of the poster child for that, but it's building up in other countries as well. And one of the things, obviously, as we mentioned, that Han can do is get you onto these different platforms to be bought within these savings plans. but we can also offer to set up pay-to-play deals or different content deals with these platforms to make the fund or the ETF more attractive on that platform. And finally, as a slight outside of the platforms, if you wanted to gain assets from, say, a large institutional buyer, you have the ability to offer rebates in Europe. So this is more for the US side. It's something that we do a lot. Obviously, if you have a large institutional buyer that wants to put in a sizable allocation, but want to get a slight bit of money back, given the fact that maybe they're an early investor or something like that, we have the ability to draw up rebate agreements directly with the client outside of the fund, so all customers are treated fairly. So that's something we can touch on maybe later, but it's definitely a done thing in Europe, and there's it's not cloak and dagger, but maybe a bit more like it's not allowed in the US. So we appreciate that, Tal. Thanks very much. Going over to James. Obviously, we've spoken about a few things already, different, say, index-based funds or the rise of active funds. But maybe talk about active a bit, but the first and foremost is, what is the role of ETF market makers and what service are they providing to the market?
Yeah, sure. I suppose the main service that market makers provide is liquidity and providing liquidity to the markets. It would be ideal if, we had lots of retail flow on both sides, lots of buyers and lots of sellers in the market, in which case everyone would match off and there'd be no need for this extra liquidity provision. Unfortunately, in some markets, liquidity is hard to come by, and you need market makers in those cases to step in order to keep the spreads as tight as possible. So it's a service in, providing a place for buyers and sellers to be able to execute their trades at a reasonable price. And there's a lot of different terms that get thrown around, particularly in Europe, in terms of the market making space. You've got, first of all, what is an AP? An AP, an authorized participant, just is someone who's allowed to interact with the fund itself, be able to create and redeem shares of the ETF in what's called the primary market. It's basically an exit strategy for market makers to be able to take large flow either on screen or RFQ, and have a facility for us to be able to interact with the fund, to be able to offload those shares and create new shares in the ETF as a result, or facilitate redemptions in that way as well. And with that mechanism allows the market makers to keep the spreads as tight as possible. We also have a couple of other terms. One is known as a designated market maker. So a designated market maker is a market maker who is signed up with an exchange in order to provide liquidity at the exchange's terms, which could be, the amount of time they spend in the market, so their presence, the size on each side of the book, and the spread as well. And then going a step further than that, we've got what's known as a contractual market maker. So similar to what we have in the US with a lead market maker, in Europe, we have contractual market makers who have an additional agreement beyond the exchange requirements. And this agreement is with the ETF issuer themselves in order to provide even tighter spreads than the exchange requirements, more liquidity than the exchange requirements. And really is one of the key drivers to a product's success as well, is market makers being able to provide extra liquidity, tighter spreads, reducing the costs to investors right across the board. And in particular in Europe, we don't have as much retail flow. It's a lot of institutional flow in Europe. Up to now, it's important that market makers are there, providing liquidity at all times throughout the day, particularly on screen, but also via RFQ for any larger tickets that come in.
Yeah, I mean, it's certainly a question that we get asked a lot as a white labeler. It's what people see as a challenge, the sort of the seeding, the cap markets and distribution side. Can you just talk about seeding, perhaps? Because it's obviously something that's quite important for managers coming from the mutual fund side, the ability to be able to launch their fund on a particular day due to the seeding capabilities of groups like yours. But maybe you can just sort of go a bit into that if you can.
Yeah, it's an interesting point. There's many different ways of seeding an ETF. In the past, what has been done is, mostly issuers or asset managers will come to an AP and they'll ask them, to provide seed capital, which could range anywhere from $1 million upwards, and they then sit in that inventory for an extended period of time until a buyer in the market comes in to take that seed capital off them. Usually, in that case, there's no cost to the AP in terms of creating the shares in the first place. But the cost comes with the holding onto that position until a buyer comes in the market. So there's financing costs. Back, prior to rates rising so much, this was a cheap business for market makers to get into. Now it's a lot more expensive with higher rates. So it's something that asset managers have often tried to do themselves instead of going through a market maker like us, where they'll have a large client who wants to come in and trade this fund straight away. So what the issuers are doing is, or the asset managers are, they're providing the seed capital themselves and using the AP to initiate that first creation. So the APs are doing the create on behalf of the asset manager, who then hold the shares, and then are able to offset that or offload that to the buyer as soon as they get into the market.
Yeah, it's certainly something that we're starting to see. I think the important thing for anyone looking at launching a fund via a white label, i.e. HANetf, is that we can always get you a certain amount of seed to get the fund going at a particular date. And it just means that you're not waiting for the client to turn up on the day, as it were, which means that then you can list and start your fund at an appropriate date that's suitable for you. One of the other topics that comes up quite a lot is ETF share classes. Obviously, a lot of mutual fund or traditional mutual fund houses are now looking at the ETF wrapper to offer that wrapper as part of their service to clients. So maybe if Chris, we could start talking about ETF share classes. So launching ETF share class in mutual fund structures is obviously a big talking point in the US since the end of the Vanguard patent. How does this work in Europe, and is it possible to launch funds with listed and unlisted share classes? Over to you.
Yeah, it's definitely one of those topics that's been discussed a lot over the last number of years. And as you say, particularly, since that Vanguard patent rolled off, and more managers making filings with the SEC looking for their ability to do it. But, it's worth, remembering the drivers are different from a tax perspective from the US, and the analysis in an Irish or European context is a little different as well. So, starting point is it's been possible to do this in an Irish ETF since 2018. But the reality is not many managers implemented the model. There are a number of examples of ETFs having non-ETF share classes available in their fund documents, but again, not necessarily having launched those. Then HSBC launched their ETF share classes, launched ETF share classes in an unlisted UCITS fixed income platform a couple of years ago. And they sort of brought it up back into focus for everybody. And, as you said, sort of seeing more interest from those traditional asset managers looking to explore adding ETF classes potentially to their existing unlisted platforms. One of the barriers had been, that, until last year, the central bank required that if you're issuing an ETF share class in an Irish UCITS, you had to include the identifier UCITS ETF in the name of the fund itself. And some managers were just uncomfortable with the idea that this could be misleading for the fund, particularly if that fund was predominantly unlisted. So one of the really helpful developments over the last year is that the central bank will now permit you to include that in the share class name if you want, rather than the name of the fund itself. And so if you're a manager of a large unlisted UCITS and you want to add an ETF share class, just maybe to bring a new distribution channel on, then you can do that and just keep that identifier in the share class name and keep your sub-fund name the same, which might be a more palatable option. Now, we always need to caveat discussion around ETF and non-ETF share classes by flagging that it might impact on your fund's ability to access the US-Irish double taxation treaty. There will be lots of cases where it doesn't, but to the extent that your existing UCITS ETF is domiciled in Ireland, has a large US equity allocation and wants to continue to benefit from that treaty, you do need to consider that and make sure that you're not threatening that at all with implementing this model that out.
Yeah, so I think you've touched on an important point there, which I'll just clarify for any listeners that aren't aware. There is a tax advantage in Europe for UCITS ETFs domiciled in Ireland. So those ETFs domiciled in Ireland pay 15% withholding tax on US equities versus 30% for any other mutual fund there, or in say a Luxembourg domicile as well. So there's a sort of a clear structural alpha that you can gain by listing and domiciling an ETF in Ireland, and all of the building that we do at HANetf for UCITS ETFs is done in Ireland. Obviously, Chris, for traditional mutual fund houses who have a large amount of assets in these more traditional mutual funds that they run, the ETF share class is an attractive option for them to look at. So appreciate all of the information you gave there. So Hetal, just going back to something we discussed earlier. One of the questions we get is, why do you think we're starting to see increasing international demand for UCITS ETFs? What do you think the rationale is behind it, from your perspective as an exchange and someone that sees a lot of flow?
Yeah, I think we've already touched on it a fair bit, some of the benefits of it, but from a trading perspective, we're also seeing obviously a lot more growing liquidity. So like we mentioned earlier, new pockets of investors from around the world looking to connect to our markets, looking to connect to European markets for the sole reason to be able to trade UCITS ETFs. I think with the transparency evolving, and then the better reporting, aggregated volumes on exchange, average trading spreads of UCITS falling, I think they're probably some of the reasons we see where we're having conversations with banks and brokers from some of these regions. Obviously, Chris has touched on it. You've touched on it, Josh. Some of the features, just being able to have either an accumulating, distributing ETF, so you can control the income and control the treatment of how your income's dealt with. Multiple currencies. So something at SIBO we're quite strong with is the fact that we can list ETFs in up to 20 different currencies. So it just allows you to align your reporting and your trading to the currency of your choice. And so I think just more flexibility, lower costs. There's a lot of reasons, but I think for all intents and purposes, probably seen as, we've heard this before, but it's the gold standard, I suppose, of ETFs, especially in Europe. And I think more and more, the reliability you get with that, I think that's what's appealing to even ordinary investors across the world.
Yeah, definitely. And I think you could touch on a couple of other important points there. Just to clarify for anyone that doesn't know, is that you can offer multiple share classes within an ETF. So you can have accumulating, distributing, hedged in various different currencies. But also importantly, if you want to offer currencies, as Hetal said, there's the ability to have trading lines on the exchange within multiple currencies. So unlike a mutual fund where you would have to offer different share classes for this, effectively it's an unhedged version back into the master fund, be it in dollars or sterling or whatever it may be. But it gives the ability for someone wanting to buy in sterling or euros or dollars to do so on a single exchange. So maybe just moving back to James. Another question that's asked a lot is, how are market makers adapting to the change in the ETF ecosystem over the last few years? So in terms of what you're seeing, how have you had to adapt your business for various different types of strategies, asset class, etc., being utilized now by issuers?
There's an enormous shift in the ETF ecosystem in both Europe and the US over the last, we say, 3 years. We've seen, first of all, a huge amount of new products listing right across the board. We've seen a huge increase in the number of issuers coming to market. And probably the biggest change of all is the complexity of these new products that are launching. So market makers have had to do a lot of adapting when it comes to providing liquidity for these new funds and new issuers. I suppose I can't really speak to all market makers. Everyone has a different way of how they manage this, but what I can speak to is the Virtue's point of view and how we've gone about tackling this problem. So Virtue have created what's called an ETF pricing team, which is a centralized group of ETF experts that look to fundamentally value all ETFs globally. So what we do is we build processes that will gather as much information about all of the ETFs as we can, and bring it all in-house, run models in order for us to be able to create the best fair values possible in ETFs. So while building these processes, we try to centralize everything and make it as scalable as possible. So if there is a new fund listing, it only takes us about 10 minutes for us to be able to set that up and have a price in our system and be able to, respond to clients' request for quotes. In that centralization, on the pricing side of the ETF, it allows our trading desk to act more as risk managers, focus on position managing, and actually market making the ETF, which kind of drives the whole centralized book part of the trading desk. It really means that if we have a client in Hong Kong, for example, that wants to trade a US ETF in European hours, we can facilitate that because of this centralization and this scalability that we've built into the system that's right across the world. It's right across, our APAC market making team, our European market making team, our US market making team. We're all using the same system. We're all looking at the same risk book, and we're all able to, respond to, quotes that are coming in from either asset managers or any market participant, really. So yeah. First thing would be a huge amount of work that's gone into the scalability. I suppose the next biggest thing would be because of the amount of new issuers that are coming on board, it's really up to the individuals at market makers to build relationships with these new issuers that are coming online, partnering with them to understand the funds more, and really kind of have that two-way conversation around how best to market make these funds, how best to manage the whole process from a cap market side, from a portfolio management side, in order that we're getting the best data possible, we're providing the tightest spreads possible, and clients are happy at the end of the day.
Yeah, that's very useful, and obviously that's the difference between a mutual fund and an ETF is all of those elements, which obviously Han can help with, because we sort of oversee all of that vertical, the capital markets part, which is the most important. It's what changes a mutual fund into an ETF, and all of obviously the roles underneath of the exchange and the market maker. So maybe just back to Chris. So we've been talking about launching ETFs on both new platforms and on existing white label ETF platforms. Maybe you can just talk us through the timing differences and the speed to market for each approach, if you can.
Yeah, sure. So, when you're looking at what the regulatory process is for the authorization of a platform or a product, ultimately, as I mentioned earlier, these are either UCITS platforms or products. So, from the central bank's perspective, the authorization process looks pretty much the same as if it was an unlisted standard UCITS product. There are some specific ETF regulatory requirements which would not be standard for UCITS, such as the portfolio disclosure piece or the UCITS ETF identifier that I mentioned as well. But otherwise, timing pretty much the same. So when you're talking about a platform, it's necessarily a bigger project, right? You have to choose directors, service providers, negotiate material contracts, get a base prospectus cleared by the central bank, and manage that project from start to finish. Like the central bank piece of it, you're probably talking 3 to 4 months from that initial filing with the central bank, but there is quite a body of work required to get you to that initial filing point. When you're launching an ETF sub-fund on an existing white label platform, it is a more straightforward project, as you're really just focusing on that supplement where it describes the specific strategy of the ETF that you are putting in place. And then you have the investment management delegation agreement as well to put in place. So on that one, you're probably talking about more that 10 to 12 week timeline, Josh, that you sort of outlined at your presentation in the start. I mean, the challenge from a legal and regulatory perspective with launching an ETF for the first time is the same as, it is for from the management or operational perspective. You have to get your settlement model, ICSD arrangements, paying agent, cap markets infrastructure, AP agreements, market maker agreements, and cap markets oversight policy. That all needs to be put in place. So then, the advantage again there of a white label platform is that you will benefit a lot from the infrastructure that's already there. So, I mean, in terms of the overall difference in timeline, there's a little bit of a delta between, in terms of the central bank piece, but not major. It's probably, the bigger differences are that initial build and then the operational, implementation itself, is where you're probably getting those, from your initial slides. The 9 to 24 month piece is where really start to see that stretch, I guess, come into it, depending on how long it takes you to get returns.
No, that's helpful, and that's obviously where HANetf can help either approach. If you go down the standard white label approach, obviously all the plumbing is there, it's all inbuilt. It's a plug and play option, a turnkey, whatever you want to call it, for a manager coming along, where we can get them to market in that short period of time, versus potentially going alone. But actually the other option of incubate, where the manager may want to have their own dedicated solution, we can leverage a lot of the experience we have and a lot of the agreements that we already have. And we've done this a couple of times over now, where things like AP and market making agreements, which are the real pinch point in the market at the moment for getting new issuers launched, we can utilize our IP, which is the agreement, to get those signed up far quicker onto a new platform. So I think that's very useful, and thank you for that. So maybe, James, just going back to you for a sec. So one question also we get asked is, how can market makers work with issuers and cap markets teams to ensure their products are priced competitively? Obviously, the spread for anyone in the mutual fund world is something new, and can potentially add on a bit of cost onto the people who are buying it, from a headline perspective. So what do you do to help price those competitively?
Yeah, it's a good question. Something we get asked, quite a lot. Well, there is probably three elements, and it comes back to like funds have a huge amount of complexity in them, particularly like on the active side, and the various how active is funds can range from almost passive to a fund that has a huge amount of daily turnover. But one element that is really important right across the board for market makers to be able to provide best in class pricing is transparency. And I know that Atal touched on this a little bit earlier, in terms of the transparency, from the exchange side. What we need in transparency from the market making side is the transparency in the fund holdings themselves. And understanding what the fund is holding at all times throughout the day is really important for us to be able to generate correct fair values for the fund. Understandably, this transparency has a range as well. Some asset managers will want to keep as much of the trading in-house themselves and only disclose what the trades are after the fact. There's other asset managers who are, happy to provide the information to the market makers ahead of time, like we do for passive funds, for example. So if we take one example of an active fund that might be changing the shape of the basket at the close today, what we see in the gold standard of transparency is that the issuer will publish a forward-looking creation basket, which will show us what the fund will look like at the close. And it also publish a fund holdings file, which will show us what the fund is holding currently at the start of the day. That allows us then to price intraday really competitively, knowing that this is exactly what the fund holds. We know that our hedge is good versus that. And when it gets to the close, we know how, if we do end up holding a position overnight, we know what to change our hedge by, because we've got that forward-looking create basket. So it allows us to, one, provide really good pricing intraday, but it also allows us to, enables us to hold positions over the close and, have less variance in our hedge. The other thing is the relationships, obviously, we were talking about with capital markets is super important. This two-way conversations, we talk to capital markets teams all day, every day. We're constantly going back and forth. One, to understand how the funds work, but two, when there are data discrepancies in our models, it's often the capital markets teams and portfolio managers that are liaising with the market makers to figure out if it's a real discrepancy and something that happened unexpectedly in the fund, or is it a genuine issue that needs to be corrected. If it is, we're working with the issuer to, understand the fund better, figure out what the fund is actually holding, in order for us to be able to get it back into the market as quick as possible. So that communication with the capital markets team is super important. The last piece of the puzzle is the from the client side, it's really up to the issuers, the capital markets teams, and the market makers to ensure that any counterparty out there is signed up and onboarded with the correct liquidity providers, making sure they're well connected right across the board, in order for them to be able to one, access liquidity on screen, but two, access liquidity via RFQ should they need to.
Yeah, definitely. No, fully agree with that. And that's obviously where, a white label, that turnkey, you get that plug and play solution straight away of multiple APs, multiple market makers, at the source of launching your fund. And one other point I'll come back to, I think it was your second point about dialogue. It's something we're obviously a big launcher of active ETFs over the last few years. We've got the broadest range of any white label in Europe across equities, fixed income options, etc. We're starting the conversation and the dialogue a lot earlier now between the actual manager and the market maker to give a really good idea to the market maker of, what does the manager run? How does their strategy work? How does it change through time? All of the things that that you guys need to know to be able to price as competitively as possible. So just conscious of time, so I think we're coming to the end. I think we'll probably finish with an outlook question and go through the panel, so you can get your crystal balls out, guys and girls. What's your outlook for 2026? What do you think is going to happen? How do you see the market moving, etc., or the ecosystem rather? Let's not predict markets. Starting with maybe Hital.
Yeah, I would just say more of everything that we've spoken about today. So obviously some of the things we mentioned on international expansion for UCITS, the rise of obviously new issuers from various regions trying to enter Europe, potentially the rise in the use of white labels as well, hopefully. And then finally, from a trading perspective for us, obviously the hopeful and growth of on-exchange trading, with more innovation, like some of the banks driving things like electronic execution and equity-like algos. So for us, yeah, probably that. And one other last thing actually is obviously there's a lot of fragmentation at the moment, so expect different types of innovation and initiatives to try and address some of the fragmentation as well.
Great, thank you. Maybe Chris?
Yeah, I think 2025 has been a real breakthrough year for active in Europe, and I think that's going to really accelerate in 2026. Yeah, so a lot more active strategies coming to market, a lot more variations around that. And then hopefully with that, sort of better penetration into the retail market and distribution among retail investors in Europe as well, starting to take hold through new platforms, sort of, and better digital platforms as well that are becoming available. So I think they're my predictions. Let's come back to me next year and see.
Hopefully they're true. And James, finally with you.
Yeah, I think I'd echo a lot of what Chris and Hital said there as well. I have a take that is a little bit different. I think that the launch of more active ETFs in Europe is actually going to drive a lot of the retail interest in ETFs in general. So I think, yes, you'll see a lot more active ETFs come to market, but I think it's going to drive a lot of retail interest in potentially passive ETFs at the same time. I think it's going to broaden the investor pool, we'll say, in Europe. So yeah, I think it's a good sign. We know what happened in the States with active. It's, you know, attracted a lot more retail investors who are now not only investing in active ETFs but also in passive. So I think it's a great thing for the European market.
Yeah, no, I agree with that, and I think, you know, we've got a bit of a crystal ball, because obviously we talk to people about their ideas quite a long way ahead of launches, and certainly we see no sign of things calming down on either the index-based or active approach into 2026. So I think it will be a very, very interesting year. So I just wanted to say a big thank you to our panelists for their contributions and insights. HANetf will be in touch via email following this webinar. But if you do have any queries in the meantime, please visit buildanetf.com, which contains a lot of information about launching an ETP in Europe. And I just wanted to say many thanks to the audience for your attendance, and thanks to the panelists again.